This meeting is being live streamed. This is Value After Hours. I'm Tobias Carlisle, joined as always by my co-host Jake Taylor. Our special guest today is the inimitable microcap maestro, Ian Cassel. How are you, sir?
Doing great. Thanks for having me. Always a pleasure.
Welcome back, Ian.
In what's been happening in small and micro cap world? It's been a market of large and growth, and so just what from your perspective, how's the landscape looked for the last year?
Well, I think that it's been a good year for kind of smaller, profitable, growing microcaps. We've seen a lot of outperformance in kind of that flavor or factor of kind of growthy, profitable, small.
Hmm.
You want to look at it like that? Even our, I don't know, our microcap club profitable index that we have, which is nothing more than the 1,200 companies that were profiled on microcap club since inception, screened for trailing 12-month profitability, and then equally weighted, rebalanced every quarter. So just that, and that's about 273 companies. That was up 44%, I think,
Mhm.
44.8%, for the year. And so kind of like that profitable band, I think, did fairly well, in 2024.
Did that
Um,
come pre-election results or post-election, out of curiosity?
it was doing fairly well even in fact, I think it was almost like up 35 going into November,
Okay,
so a lot of that performance was
already
still
in the
front
bag.
loaded. Yeah,
Yeah.
yeah, which was kind of interesting. And I'm interested to track to see how that we just started that a year ago, and honestly I was just curious to see how just this I don't think there's any real tracking mechanism for small, profitable global microcaps, and just equally weighting that basket and see how that performs, over time. And I think the other interesting takeaway that I noticed during the year was in the in the rare moments that the markets were down during the year, when we had like 1 or 2 days when, made the markets down 2 or 3 or 4%, that index was down a lot less.
Huh.
So the volatility to the downside was a lot better, in that kind of profitable segment of microcaps,
Which is not
compared to
not
even the
normally what you
S&P.
might expect, right?
No,
Usually you're
no,
kind of
not
the
at all.
tail end of the whip.
Exactly. And I don't want to say there's too much signal there yet because, until we have a period where the market goes down more than 3 days in a row, maybe by day 10 or 12 or 15, it's finally risk off, hit the bid, even in that segment, so I don't want to come to any conclusions yet, but it's still interesting to track that segment of the market. And I think, you've seen a lot of kind of Canadian profitable growing companies doing well
Hmm.
in the year. You're seeing a lot of takeouts in Canadian profitable companies that are microcaps, nanocaps up there. It seems like there's one a day, from U.S. private equity taking out a Canadian small business that's trading at single digit, EV to EBITDA or something like that. I mean, it happened quite a bit, so it'll
Hmm.
be interesting to see how that does
So a lot of the
going into
return then was
25.
actually like crystallized as
Yeah.
from
I mean, I
takeout.
don't want to say a lot of it, but I mean,
But
there's
some.
definitely a lot of M&A activity, and it might be a function of, I don't know what the function would be. Maybe it's just that people are just finding more value, kind of in that area of the market.
How have
What?
Canadian equities done relative to US equities? Are they like the rest of the world, just lagging? Is it a valuation? Are they just cheap?
Well, I think if you want to see, if you ever want to pull up a funny chart, like pull up the TSX Venture Exchange, the historical performance of that. I think it's basically flatline for 22 years or whatever it's been. And so it was like giant, like risk on kind of during the heyday of junior mining, which was like '05 to 2010, and then it's just been like straight down. And I think it's starting to come back a little bit. So I think it depends on what segment of the market you're looking at. And I think just like anything, you can find a bull market anywhere. You can find one there too. And I think in Canada, kind of if you're a small non-resource company growing 20% that's profitable, I think you saw a nice lift in your equity, during 2024.
So does that mean that the opportunity set has thinned out materially, or is there enough new blood
I
to?
don't know. I mean, I tend to think that there always tends to be opportunity. Like even from the investing that I do in the US markets, it doesn't matter if like your watch list or sandbox is 100 companies or if it's 500 or 5,000. It's like there's always something to do. There's always something that is trading out of whack with where it should be priced, and that's what I find too. Like we were very active in 2024 as a fund, added several new positions, and you wouldn't think that would be the case, or if you maybe thought that I'd be style drifting up to growth more, because of that, the way the market's performing. But no, it's like we're just, there's always, 1 or 2% out of your watch list that is probably actionable, and that's just happened to occur, for us in 2024 as well. So I don't think it really impacted the opportunity set too much, to answer your question.
Do you think that it's a little more difficult to tease out? There's a question here about value and growth, but in small and micro, small value, I don't know what that is like, but small growth is. I mean, the way that you're doing it, you're thinking about where's this business going to be in 5 years' time or 10 years' time, and when you're paying what you would regard as cheap prices, or you're thinking about some future point rather than a more traditional value analysis, which is it's cheap on its current metrics. Is that a
And
fair description?
yeah, well, and it is interesting because I'm curious, what is the definition of small cap value? When everybody says how poorly it's doing, like how's that defined?
It's probably compositional. It's just filled with all of
Yeah,
those TSX venture mining companies that haven't worked since 2005.
yeah, yeah. It is interesting when you think about, if your goal is to find small companies that can grow up into larger small companies. It's always fascinating to me to think about, we as investors tend to silo ourselves into a flavor of investing, whether that's, you can almost put it on an x-axis. It's like deep value, GARP, growth, hyper growth. And we tend to silo ourselves into one, or maybe we traverse and go into two of the four or five or something like that. And what's interesting is like the best companies, obviously, they go in and out of all those segments. At any point in their maturation, they would have probably attracted a deep value investor. They would have probably attracted a value, a GARP, even a growth, maybe not hyper growth, but at
Yeah.
least those first four, and
And the
it's
company never
hard to,
knows the price that you paid.
yeah. Well, and it's funny, it's like a lot of people don't like to say, like, well, who's going to buy the stock for it? As an investor, I'll actually think about who I'm going to sell my stocks to, and it's not readily admitted by a lot of stock pickers or anything like that. But I don't think about, hey, I'm going to sell to Jake or to Toby, but I think about
Some other bag holder.
yeah, what type of investors, what type of trajectory is this business on, and I think about like the institutions are attracted to a certain type of company, and does this
Yeah.
ultimately fit what they are looking for?
Yeah, it's
And
all, I mean, it can be a game of pattern matching coming in and
yeah,
going out, right?
yeah, but and it'd be easy for me to then say, well, we as investors need to evolve with the companies so we can capture the full right tail of this big winner. It'd be easy for me to come to that
Yeah.
conclusion, but we can honestly find just as many great investors that stuck to their silo and have done really, really well, whether that's Buffett in the 50s and 60s, sticking to a deep value, high turnover approach. I mean, he arguably had the best returns of his career back then. You know, or even somebody like a Michael Melby, who I just interviewed on Microcap Club 2, which almost exactly is that Buffett approach from the 50s and 60s, kind of sticking to that knitting and being, having some firm parameters on valuation and all those things. They didn't evolve up into some growth, and they're still cranking out high returns, So
Mm.
I think you just have to know what you are and what you want to be and stick to it and do it well, and you can outperform. So that you don't have to just hold on to everything for the long term per se.
And do you have any thoughts on, I saw some chart that showed like it might have been 3 to 1. There's number of private companies versus public companies. And a lot of that is a function of public number of companies is shrinking. I think, the Russell 5000's got 4,000 companies in it or something at this point. And it's easier for a company to stay private longer because there's so many sources of funding that they can get access to, less constraints on, having to file. I know it's, the cost of that has come down also as well quite a bit. But is there any concern about with companies staying private longer that more meat is taken off of the bone before it gets to finally be a public company? And if you're only looking at public companies, especially maybe earlier or smaller public companies, maybe maybe someone's already taken too many bites of the apple by the time it's getting to you now compared to 25 years ago.
Yeah, I mean, I would love to see more real, small, profitable, growing businesses going public when they're small, and I think there's a lot of false narratives out there that a lot of people just buy into because they read an article and it says that it costs $5 million to be public, which is complete BS, by the way. And everybody just, okay, well, I guess I can't go public then. I don't even want to think about it.
What do you think
What do you think
now?
it costs?
Yeah.
I actually asked my portfolio of companies about this, and one of them is on the New York Stock Exchange. Another one, I would say the average, if you're a listed company, if you are going to be frugal, and again, being public, it's the same thing as buying a car. You can buy a Bugatti for $3 million, $5 million, or you can buy a Honda Civic that's 10 years old for $3,000 and get to the same destination. And so it's your choice. You can pay consultants as much as you want. They'll take your money. You can pay attorneys as much as you want. They'll take your money. You can pay the highest class, whatever, auditor, whatever, but there's also frugal ways of doing it. And so for the folks that I'm invested in, I would call them on the frugal side. I would say it's probably between like $500,000, $700,000, a year, even to be kind of listed. And that is normally, if you're reading an article in this, they're saying that it's $3 to $4 million a year of an additional cost to be public on top of your normal business expenses. And that's just BS, because I can tell you right now, if it costs that much, there would be no microcap space that exists today, if it was actually that much.
Yeah.
And so I think you can, and if you're on the OTC, I mean, it's probably like 300,000 or 400,000. So is that insignificant? No. Is it insignificant? No, it's still a decent amount of money, but at least when you're, 10, $20 million revenue, it's something that should be part of the conversation.
It's
And
a big difference between 1 or 2% friction and not 10 or 15%.
Yeah. And the other thing that people don't bring up when it comes to being public and small is just the benefits. Nobody talks about the benefits of being public. And I don't mean just raising capital. What I mean is, like, if you could be selling toothpicks, and if you're growing 10% a year, growing the bottom line 20% a year, and if you can do that over 5 years, you're going to get a 20 PE as a public company. I see it all the time. Like, it doesn't matter. And so if you believe in yourself and your small business that you can consistently grow revenues and earnings and don't have to dilute, you're going to have, a company that's probably traded at 20 times earnings, and you don't have to sell it to a private equity shop for 5 times, and then you have, depending on what you're selling, it might benefit you to be public, to have a public brand for whatever you're doing. And so
there's a reputational bump there of like,
yeah,
it's skin in the game. It's, you have something to lose more so when you're a public company.
Yeah. So I think one of my big kind of missions, at least starting last year, was just even thinking about even creating a website just about like the truth about being public and small. That's, what I mean?
It's not that expensive.
And I was out at the Main Street Summit a year ago, and I gave a presentation on this topic, and it was really cool because there was, probably 300 people in the audience. And after I gave the presentation and I gave examples, I'm like, and here's Armanino Foods trades on the OTC. They're the market leader in the US in pesto sauce. They have 70% market share, and their stock is a 30 bagger in whatever it was, call it 15 years. And all they did was take a $20 million business and turn it into a $50 million business. And they took earnings from 500,000 into 6 million, and they didn't dilute. That's what a 30 bagger looks like. It's not finding Google and making it go to, $1 trillion market cap. it's simply a small business that can just grow revenues and earnings and not dilute me over a long period of time, and that's what a real multi-bagger looks like. And my guess is there's people sitting in this audience that have a business that's 10 or 20 million, that you believe in yourself, your ability to execute, and you have a good quality business. I'm not saying you should be public. You probably shouldn't, but it should at least be part of the conversation, So
I think for your employees also, that liquidity can be a really meaningful thing for them. And when you're a private company and it's locked up and somebody wants to buy a house, it gets kind of complicated on how exactly they're going to, and you can
mhm.
borrow against now. There's all kinds of different tricks around it, but just having a public market for your ownership is a nice benefit for an employee potentially.
Yeah. But there's still, I mean, it's like the law of large numbers. If you're like, well, there's no more companies going public. Like, well, it's not exactly the case. There's 150 IPOs, 80% of them are microcaps. There's still like 100 SPACs done a year. Majority of them are microcaps. There's still 100 reverse mergers done a year. Those are mostly microcaps. So there's still 200 or 300 new companies entering the system, every year.
Mm.
And a lot of people that mention the decline, which they are, of listed companies. I mean, there's still a relatively the similar amount of small companies that trade on the OTC, over the last 5 or 7, 8 years. That's been pretty constant.
Mm.
And a lot of the ones that, and you could say maybe there's a quality difference since, versus 20 years ago of those companies going public, which there probably is. And that's what I'd like to get higher, get higher quality, small public companies, public.
Yeah.
But it's not as bad, I don't think, as what people think.
Yeah, I thought Sarbanes-Oxley made it like $1 million a year more expensive. It was $1 million on top, which is when it came out. That's a long time ago now, so folks have probably figured it out. But that was the inflection point, I thought, where
Mm-hmm.
there had been more and more public companies coming online, and then the universe started shrinking from that point.
Yeah, and you're probably right. It's probably one of the tipping points, but I think a
Thanks,
lot of
Ken
it,
Lay.
yeah.
Let me do my quick shout out.
Oh yeah.
Valparaiso, what's up, Mac? Brandon, Mississippi. Philadelphia. Lima, Peru. London. Tomball, Texas. Bremerton. Toronto, Tampa. Savonlinna, Finland. What's up? Moncton, Canada. Breckenridge, Luzerne. Oregon City. Bangalore. Sugarland, Texas. Kapavoga, Iceland. Trying my hardest there. Blanchester, Ohio.
Greenland, we're coming for you.
Yeah.
Wollongong, New South Wales. Cabo, good for you. Cabo San Lucas. Austin, Texas. It's Hugh. I don't know how you pronounce that last name. Yanis. Jupiter,
Oh,
Florida.
you just got tricked into one,
Cincinnati.
didn't you?
Did I really? Kate
Yeah.
caught me. Saskatoon, Bellevue, London, Toronto. Very good.
Ian, I think you had you kind of pre-prepared a little something for us that was about the differences between good investors, great investors, and then greatest of all time investors.
Yeah, I started journal about this maybe a night or two ago, and this is a very rough thought process. So
That's all we do here. It's just
yeah, it's
real
very
rough
rough.
stuff.
Very rough and very wrong, but
That's a good place to start. Let's do it.
yeah,
That's good.
exactly. But I think I'm right. No. But I do find it interesting when you think about sports or stocks or even stock pickers themselves, kind of the difference between good versus great versus GOAT, greatest of all time. And that's what kind of got me started kind of journaling a little bit. And I think it's hard to have a conversation like this without kind of defining what good and great and GOAT even mean. And for this, I'm mainly just talking about the difference between great and GOAT. And so and again, this is completely subjective, but I would say a great stock picker is an active manager that beat the market for 15 years. That's a decent amount of time. We could argue whether that's 10 or 20, but it's hard to fake it until you make it for 15 years and still beat the market. So, I think it's kind of a tough 15 years because our starting point is like the low in the market. And,
Yeah, you only had half a cycle really. So
yeah, exactly. So I think the average CAGR on the S&P for 15 years is I don't know. I think it's like 14%,
15 or yeah.
14 or 14 and a half, something like that. But let's just say to be great, you would have to beat that. So let's call it 15% net, over 15 years. And when you actually look at the statistics, and I think Alpha Architect actually did some of this, but I was trying to look at some of the data points, but I think it's roughly 5% of active managers beat the market over 15 years, which might surprise some people, probably not us, just because, and we've heard about that narrative before too. It's hard to beat the market, obviously. So that would be great. Let's just call it a 15 net return, annualized return for 15 years. On the GOAT stock picker side, I kind of define that as somebody that has beaten the market by 500 basis points or more over those 15 years. So taking that 15% net CAGR up to 20, and that is a big leap, and it's meant to be a big leap. And it's probably, 3 or 4% of even the great kind of stock picker band, kind of fits into that category. So great, 15% annual returns, GOAT 20% over 15 years. And so for me, like kind of thinking about this, what are these great and GOAT stock pickers doing to beat 95% of professional active managers? Both those categories, they're beating 95% of active managers. What are they doing? And last year in August, I gave a presentation talking about the skills of stock picking, and maybe you can put in the show notes. But what's interesting about this presentation is I think a lot of people read the title, "The Skills of Stock Picking," and their eyes glazed over, thinking that it was going to be, the invest like Ian presentation, bore them to death, that type of thing.
It's all accounting.
Yeah, exactly. And it wasn't that at all. So it's like it was mainly like literally the first 95% of the presentation is me talking about Brazilian Jiu-Jitsu and how Brazilian Jiu-Jitsu got started in Brazil by the Gracie family and how it spread globally. And really within 100 years, it kind of became the dominant martial art that, is all around us. And you probably heard of it too. And so one of the people that I talk about at the very end of going over the history of Brazilian Jiu-Jitsu is a guy by the name of John Danaher. And John Danaher is highly regarded as one of the best, if not the best, Brazilian Jiu-Jitsu instructor in the world. And he's been interviewed by Joe Rogan. He's been interviewed by Lex Friedman. You can pull up those interviews, and I'd encourage you to listen to him because he's just a cerebral dude. And that combined with his kind of New Zealand accent, he's very easy to listen to. It's kind of like Toby, so easy on the ears. But you find out really quick that just like Toby, he has a lot of horsepower between the ears, and he's even though he's a mixed martial arts instructor, the best in the world, he actually was a philosophy major in undergrad, and then he was a philosophy major in graduate school, and then he went to Columbia University in New York City to study philosophy for his PhD. So this is a person that enjoys thinking about thinking,
and he can cave your head in.
Yeah, exactly, exactly. And so it's in one of these interviews that he did, I think it was with Lex Friedman, where he's literally asked, how do you become the best in the world, at what you do? And he gives this great answer. It was something like, in any sport or profession, there are 5 or 6 core skills that you need to be able to do to participate in that sport or profession. And he basically said that to be the best in the world, you need to be good at all 5 or 6 of those skills, and then be really dominant, best in the world in at least 1 or 2 of those skills. And so it kind of got me thinking, the premise of this presentation I did a year ago or 6 months ago was, all right, so what are the 5 or 6 core skills of stock picking? And I kind of just thought about it and wrote on it. And it's basically the last part of that presentation. And, basically the 6 skills I had for stock picking are: number 1, identifying ideas. So, finding actionable ideas before others. Number 2, valuation, determining intrinsic value. Number 3, buying or sizing your conviction. Number 4, holding, maintenance due diligence, knowing what you own at all times. Number 5, selling, the skill of letting go and moving on. And then 6, kind of survival, your ability to adapt and evolve as a stock picker, with the market environment or, over time.
I didn't hear pumping your meme coin in there.
Yeah, we're doing that too. That helps.
Okay.
So I think, to become getting back to what Danaher said, you need to be good at all those skills. I think to be a great kind of stock picker, you need to be good at all those skills. And the cool thing about those skills is it doesn't matter whether you're deep value or hyper growth or short-term, long-term, whatever it is. I think those skills apply to anybody that is a stock picker. And I think the ones that are great, the ones that can outperform the market, just do a really good job focusing on those skills. They're really good at it, and they do it consistently, kind of over time. And then, so that's where I think it becomes great, and then for the GOAT ones, Danaher goes into this, and I didn't share this in the presentation. This would be like a part 2, but he actually goes into detail on what does it mean to be a GOAT? Like, what are the GOAT stock pickers doing differently than the great stock pickers? And so for that, he kind of gave some examples, even with his using Brazilian Jiu-Jitsu as an example. And he talks about when he trained St. Pierre, who is kind of highly regarded as probably a top 2, if not the top mixed martial artist of all time. And he trained him, and he talked about, when that St. Pierre was really good, and he was really good at all those core skills, but where he became great and where he became dominant was he focused in on an underappreciated skill at the time in Brazilian Jiu-Jitsu, which was leg locks. And he focused it on this area, kind of innovated on that underappreciated skill, reintroduced it back into the sport, surprised opponents, surprised the fighting style, and that created his edge. Probably that would have lasted 5, 6, 7 years, and it keeps on innovating, on that underappreciated skill. And so I think kind of applying that back to kind of stock picking, when I think about sort of the greats of stock picking, they did that exact same thing where they almost, regardless of your flavor of investing, there's probably an underappreciated skill there that other people in that flavor of investing don't appreciate. And you go in and attack that in a new way. And that becomes kind of an advantage that creates the alpha in the portfolio. And, you have and I apologize for this being such a monologue, but you have a guy like Michael Melby, as an example. We were talking a little bit about him earlier, at Gate City Capital. He's in a horrible factor like deep value, and small cap deep value. And yet he's put up a 22.4% net CAGR over 13 years, in an awful, factor like that. Like, and of course, as an investor, you sit up a little straight in your chair and you're thinking, well, small cap value has averaged 8.5% over 14 years, and he's doing 22.4% net. What's he doing differently? And when you kind of dive into what he does, it gets kind of really interesting. And a lot of it doesn't sound like anything, really novel or unique. I mean, he's basically deep value concentrated in 15 to 18 ideas, 2-year hold on average. So 40% turnover a year, looks at kind of like old economy businesses that have hard assets, land, real estate, so they can go up with inflation. Is very, very disciplined on his DCF modeling, always a 12.5% discount rate, never budgets it up or down, depending on how he feels about the market. He's very consistent. And they've just done a lot of work over 350 names that kind of fit their sweet spot in the US and Canada. And I think the one area that I would say he does something really, really unique in is the fact that he focuses on quality management teams, in a deep value type of style of investing. I think that is probably the focus of his,
that's his leg lock,
underappreciated kind of thing. Like, he literally goes out and visits every single company with the management team, sits down with them, interviews them, tours their facilities. And, when you talk to him, he's like, yeah, we probably pass on 30% of the companies that we visit just because there's something we don't like when we see it in person, or whether it's the interaction with the management team or the assets themselves, and I think he's done an interesting job of kind of finding that skill of really valuing management, because as we all know, like deep value, it's mainly, all right, let's find some assets we can buy cheap enough where we don't have to even value or even do any management analysis, and so I think he's kind of innovated on that, and that's kind of created this alpha, and he's done it consistently. But anyway, that's my rambling answer to, I think the difference between a GOAT and a great investor are really those investors that really dive deep. They do all of the basics really, really well, and they form that pattern recognition. And then obviously over time, the watch list of 300 to 400 companies becomes your sustainable edge that you did work on 5 or 10 years ago, and all that work you did 5 or 10 years ago in that same subset of companies allows you to see around corners the next time around with that same company, and that's, helps amplify that edge over time too. But anyway, that's my rambling thought that I was journaling about, over the last couple of days. So I thought I'd share.
Yeah, I love it.
I want to throw a name at you, but I don't want to do it until we do the Jake's veggies, and then we'll come back to to that name.
Yeah, let's do
We've
some
got a
veggies.
Special treat for everybody today. JT.
Oh boy, this is go ahead.
Oh yeah, that's right. Oh, hold on.
Well,
JT better introduce it.
Yeah, let me tee this up just a little bit. So I know how much Ian loves all the sperm whale related content, and so I wanted to stick with something animal themed for this week with Ian coming on. And I actually received inspiration for this segment on a daily walk while I was listening to Warren and Charlie, as I'm wont to do. And at the 1996 Berkshire annual meeting, Buffett tells this funny little story, and I'll quote right here. He says, "I made the mistake of taking Charlie up to Microsoft in December, and he became friends with Nathan Myhrvold. And they were corresponding back and forth with increasing fervor and enthusiasm about mole rats. And they copy me on all these communications. So I'm getting to see this flow back and forth on the habits of mole rats. I haven't really found a way to apply it at Berkshire, but I'm sure Charlie has got something he's working on. So just to keep it fresh with everybody, because we're on season 7 at this point. For today's veggie segment, we're going to learn about mole rats together. But first, and the way we're going to do it is a little bit novel. But first, I'm going to tell you a little bit about Nathan Mulvard. I think that's how you say his name. He's quite the polymath, actually. Showed a lot of expertise in different disciplines. At the time in 1996 of this recording, he was the chief technology officer at Microsoft. And so, he's obviously fairly instrumental in shaping the world of information technologies that we live in today. And he left Microsoft in '99, and he founded Intellectual Ventures, which was a company focused on developing and licensing IP. And he's made contributions in paleontology, actively participating in dinosaur research, like co-authoring papers on topics like the biomechanics of dinosaurs' tails, even like going on field expeditions to excavate fossils. And he had an artistic side. He's an accomplished wildlife photographer, which is probably where these mole rats come in.
Has he also written a cookbook?
Yes. So he wrote a cookbook called Modernist Cuisine. That's a deep dive into the science of foods, and including the role that animals play in agriculture and sustainability.
Just before one of the things that he was doing in that was trying to find the perfect French fry. And he decided that you had to cavitate the inside of each French fry using sound waves, I think. So it gives you a mash inside the French fry.
Liquefy it, huh?
And then you fry the outside. Sorry, so the man's doing incredible work out there. So
that's doing the Lord's work as making the perfect French fry. He even led efforts to combat mosquito-borne diseases like malaria, like by building this laser system that would target and shoot mosquitoes mid-flight, basically.
Practical.
Yeah, quite practical. So you could see why Nathan and Charlie might hit it off and have quite the correspondence. So to keep things fresh, I wrote a little play as if Nathan, Warren, and Charlie were discussing mole rats and investing and how they combine together. And so we're going to do a little live table read for you. This could be an absolute unmitigated total disaster. We haven't even practiced this at all, so it's a blind read. So buckle your seatbelts, put on your crash helmets, but we're trying to keep things fresh. So I will start off things as the narrator saying, the year is 1996. It's mid-May, shortly after the Berkshire meeting. Warren Buffett, Charlie Munger, and Nathan Myhrvold are seated in a cozy study surrounded by bookshelves filled with biographies, biology texts, and a few war-worn copies of The Intelligent Investor. A coffee table holds a large box of peanut brittle encircled by a rainbow of aluminum cans of Coke, Diet, and Cherry Coke. And in the air is a sugar high mixed with intellectual curiosity. There's a taxidermied naked mole rat. It's just sitting on the coffee table, ugly as sin. And you guys should look up a picture of what the mole rats look like to really bring this home. All right, so with that, we're going to kick off this conversation.
Well, and I'm Buffett.
Yes, sorry. So Ian is is playing the role of Warren Buffett. I'm Nathan, and Toby's going to be
This is more
taking.
lines than Munger's ever had in his entire life, but I'll do
All
my
right.
best.
All right. Since
Action.
I don't know if you can see this, but here's the Coke. So I'm Buffett. You know, fellas, I've been enjoying the fascinating correspondence between you, although it's been cutting in my bridge playing time. When you were talking about mole rats, I didn't realize how hideous these little creatures are. These things are soggy cigar butts of the animal kingdom.
Ah, yes, mole rats, nature's little contrarians. Most animals are fighting it out on the surface, but they go underground where no one else wants to be. Nathan thinks that the ideal metaphor for resilience, adaptability, and teamwork. Warren, you must agree, as you're smart, and he's right.
Thanks, Charlie. Mole rats might not be conventionally beautiful, but they're a highly successful species. Just start with longevity. These little creatures live over 30 years, which is particularly unheard of for a rodent.
30 years, that's a lot for compounding for a rat.
We've come across a few rats nowadays, haven't we, Warren?
We'd better cut you off here, Charlie. We criticize by category, not by name.
Longevity in nature, just like in investing, comes down to survival. Mole rats are built to last, and that's what every great investor should aim for, durability. It's why we focus on businesses with strong moats and avoid chasing fads.
Yeah, Charlie, their longevity is tied to their cellular resilience. They've developed unique DNA repair mechanisms, which prevents and protects them from cancer and age-related diseases.
That sounds like Coca-Cola. Durable, steady, and beloved, no matter the environment. Cases sold goes up, share count goes down.
Mole rats thrive underground in some of the harshest conditions imaginable. Low oxygen, scarce food, high acidity. They've evolved to conserve energy and share resources efficiently, ensuring the colony survives. Mole rats store food in underground caches for the lean times.
We do the same thing, but with gobs of cash.
I celebrate frugality in all its forms. As Ben Franklin said, a penny saved is a penny earned. The name of the game is conserving capital, avoiding stupid risks, and focusing on quality. Mole rats don't waste resources, going for minutes without oxygen.
Cash is the oxygen in a business. When it's around, you don't notice it, but as soon as it's gone, it's the only thing you notice.
Living underground, mole rats can tolerate extreme heat.
Ah, like a value investor in an overheated market like 1999. They don't let the outside temperature get them overly excited. I regularly have to check Charlie for a pulse. He's such a hyperkinetic fellow.
Munger makes a face for those people listening at home.
Do we still have an audience?
Yeah, no, everyone hung up by now. Mole rats use social behavior as another standout trait. Each colony is highly organized with the queen, workers, and soldiers. Every individual has a specific role, and they collaborate to keep the colony functioning.
Well, as Adam Smith taught us with his pin factory, specialization is also how humans have created so much material wealth.
There are more synergies in a mole rat colony than there are in corporate America's M&A.
Here's another fascinating fact. Mole rats are nearly insensitive to pain. They don't feel the effect of the acidic environment.
That's an enviable trait for an investor. If you can't stomach a 50% drawdown with some equanimity, you don't deserve equity-like returns. I remember Warren in 1973. He wasn't feeling the pain. In fact, he was like a kid in a candy store.
I think the analogy I used was an oversexed man in a whorehouse, but Charlie is usually the one using colorful language. So Nathan, should all investors be taking mole rats as their new spirit animals?
Well, maybe, but at the very least, they remind us that survival, resilience, and adaptability are universal principles, whether you're a rodent or an investor.
I have nothing to add. And scene.
All right. I hope I appreciate you guys for humoring me on this. I mean, this was probably a terrible idea, but honestly, this show, if I'm not keeping myself a little entertained, then what's the point? So I
That was like
appreciate
David
this little.
Mamet. That was like Glengarry Glen Ross. This is incredible.
Yeah.
Sign
All
on
right.
the line.
Yeah.
Sign on the line that is dotted.
Yeah. Always be closing.
Good
Anyway,
job, JT.
Sorry, guys. I
the
realized I
fan
could barely
fiction.
read. So that's okay.
That was the Berkshire fan fiction that no one was asking for.
Right.
So I have a question for you, and this is inspired by Ian's GOAT or great investor. There are a lot of investors out there who sit at, well, Peter Lynch has a 13-year track record. Is that I'm not misremembering that. If anybody can
Yeah.
correct me from home, the hive
13
mind.
years, 29.2%.
It's like 83 to 96.
No, 77 to 90, I think.
Okay. Oh, even better. Who ran to 96? Was that Bill Miller? Oh no, that's not right either. Forget that. What do you think about an investor who has that 12-year period, which is you can have the and then then hangs it up. He's still alive today, so he could have kept on going for 30 years more.
Yeah.
What was the reason for him giving it up, and what can you sort of is he just a good timer? He said at the end that that's the end of my market. I can't find any more opportunities. I'm off.
At some point you get rich enough where, the stress of it might not be worth the worth it anymore.
I think I think I tweeted something about this a week or two ago about him in particular. And I wrote an article about this because I am fascinated by, Peter Lynch basically pulled off the Barry Sanders, in the investing world. He
Yeah.
kind of went out on top and even says as much in the statements he made back then, about like how he wanted to go out while the champagne was still being popped, something like that. And he was only 46 years old when he retired too. And you could say that, yeah, he was wealthy, but I mean, I think if you pull up his net worth, obviously it's a lot, but it's not billions. It's, 100 million, 200 million, which is
I
obviously
mean,
still
that's
a lot.
enough.
Poor
Yeah.
guy.
But you know what I mean? But it's not like, nowadays where it's like, well, if you're not making 10 billion as a hedge fund manager, it's
Why
nothing.
bother?
But I think my guess is that he had I think just managing the portfolio probably in a public mutual fund like that was stressful combined with just the amount of work he had to do to oversee literally owning 1,200 companies in the portfolio.
Yeah, that's
It's
harsh.
just like that's one thing that a lot of people forget. Like,
Quite a bit of turnover too. I just
yeah, it's like he was not a concentrated investor. He's literally in 1,200 companies. And I
Are
think a
you
lot
doing a
of
lot
it
of
was,
oversight with 1,200 companies?
I don't know. It's a good question.
yeah.
It's a good question, but
And
and it wasn't always
I got 30
1,200.
in one portfolio and 100 in the other, and I don't know that I'd be doing.
How's
I'm
that go?
obviously not doing not well, but I'm not doing. I'm not visiting each location.
Yeah, so I don't know what the right answer is, but I imagine he was in an incredible amount of stress and just turnover of equities, and he could probably have a sense for timing, just like Barry Sanders did, just like Jerry Seinfeld did,
Yeah.
at the top.
Plus, his
And
kids were getting too old to get those investment insights from, right? Wasn't he asking
yeah,
what his teenagers were into?
but I think he did have. I mean, actually one of my favorite quotes of his was when he was managing Magellan, and you could tell it was kind of an inner ego kind of pushing him because it was just like, the fund's getting too big. He has some quote about, when the fund reached 1 billion, people told me to shut down. It's too big. You're not going to be able to outperform. They said the same thing at 3 billion. Same thing at 8 billion. And he said like the most gratifying part was he managed the largest equity fund in the country and he was outperforming, and it was kind of like a giant, I think, middle finger to all the naysayers. And
It's
maybe
pretty
that
legit.
catalyzed him
I mean,
coming
at
off the
1,200
top.
positions, you're only 800. You're only $800,000 in each one at a billion. Is that right? I think that's right.
I think it was 1,200 towards the end,
Okay.
but I think it
He
was
just didn't
always
sell.
several hundred, so
The
it's
secret
still,
was
That's
never
pretty good
sell.
there, Toby.
Just keep buying.
yeah.
I have some sympathy for that approach. I think if I could get away with it, I'd do that. Never sell, just buy. Because I think you get this behavior in some stocks where I've talked about this a little bit before, but I've done
Yeah,
these
you've
studies
done the math on it.
where I look at basically if you buy and never sell, and you can do it with any index, like you can do it with the S&P 500. Just take an S&P 500 rebalance and don't rebalance it when the committee does it next, and it outperforms the S&P 500. And it's true in just about any index that I look at. The rebalancing seems to hurt. So I think there's a reasonable argument for just buying and holding forever. But the only thing is that after about 5 years, there's nothing that is predictive. So there's a lot of randomness in it. There's value is predictive out to about 5 years, but it's not like you would think that quality would be a pretty predictive factor, but it's not at all.
I think I think it works in larger public companies. You could do that kind of a. I think you do it in larger companies which are more mature and robust. I mean, the shelf lives of smaller kind of microcap companies, they're just shorter than what investors want to admit. You know,
The th-
Mm.
they're
I think
almost
what
all
happens is,
they're almost all cyclical. You know, they're almost all have, even the winners have 4 to 8 quarters of success, and then they stub their toe, or the management teams can't innovate another product or two to sustain the trajectory. You know, and so I find in microcap, nanocap, you know, success, the average success is kind of a 2 year, 1 to 3 year success story or window. Um, and so, but I think that you can do a coffee can, especially if you're valuation centered. If you buy it, I mean, the key to everything is buying it right. You know, that your initial
yeah,
purchase price, you know, and so it's like you don't want to be, and so I think you can do that in larger ones. Like you don't want to be the, what's the overused one, like buying Microsoft in 1999 at $58 per share, you know, in that environment, you know, where it literally took
Yeah,
21
14
years.
years
No, it took
for
21
well,
years. Actually took 21 years to catch up to the S&P.
yeah, but
yeah, that makes
14 to
sense.
get to break even, I think.
Yeah.
Yeah. So it's just like, and it's just stuff you and I all know, most people know, like valuation matters. You know, your entry price matters. It's just like everything. It's like you can buy Costco at 60 times earnings, but you know, if the thing just re-rates to 40 times earnings, it's going to take 6 years to get back to the current price. You know, like nobody wants to sit on dead money for 5 years. I don't, my investors don't, my wife doesn't want that, you know.
I think the
So,
argument is that you pick up a very small handful of giant outperformers. And so you end up at the end. I've always said this, that the funniest thing is that even though you're buying incremental amounts of these tiny little companies along the way, sorry, not tiny little, tiny little amounts of these companies incrementally over a very long period of time, the ones that outperform get so big in the portfolio, and they're all the things that are working right now. You know, they're the things that are successful and popular now. So your portfolio looks like this
And you look like a
big,
prescient, just genius.
yeah, you got this Kelly weighted portfolio. I mean, it's not Kelly weighted, but it has that look. Like you got all these biggest positions, so like a few 8% positions, a few like 5 or 6, and so on. It's like that kind of shape. So it's quite a, from my perspective,
mhm,
it's quite an attractive looking portfolio because you'd be, you know, right now it'd be Google and Apple, and because all of these things have been cheap at some point over a period of time where you could have bought a little fraction of them.
mhm, yeah.
I can't fit a good story to it. If I could find a good reason for why it worked, I'd probably do something with it, but I just don't think I can't find the story. I don't know why they do it other than just blind luck.
I think it's I think it's a kind of an expected outcome of how power law driven the world
Yeah.
is.
Mhm. Yeah, you can't escape it.
It's just power law turtles all the way down.
But I
Power
like
all the way
that. I
down.
like the idea you said there, Toby, with and it's a part of investing, stock picking where I've evolved is really on the position sizing, the buying part. You know, I even talked about it in our annual letter I just sent out last week. It was just, you know, even 5 years ago, it was just like, you know, if it's not a 10 or 15% position at cost, it's not worth my time. You know, I don't, it means I'm not convicted, you know, or whatever the case may be.
Yeah.
But in
How do you think
reality, is like
about it
what I
now?
found that works better is actually for us in our strategy now is like, no, it's okay to take a 3 to 6% at cost, cap it there, and let it earn its right to be in a 10 or 15 or 20% position. Like I love having big positions, but I love them even more when they earn the right to be there, not me just trying to prove to the market that I'm right and the market's wrong. You know, so I like the idea what you said there, Toby, about, you know, kind of taking smaller positions and then, you know, doubling down when you see more success, when you have build more trust in it too, you know, allowing yourself that optionality and not going all in at once and then just, you know, treading water.
Well, there's some argument for that. That OSAM, I know, has done this. That they have a 2 year rebalancing schedule for a portfolio, so you rebalance half every year, and so they're buying whatever is, you know, they have a model portfolio, and whatever the actual portfolio is buying during that period of its buying, it's buying that model portfolio. So you have this time weighted. They get more exposure to companies that stay cheaper for longer. So because it'll just be a bigger part of the portfolio if something sits in there while it's during that buying period. And I think that's kind of an interesting approach, even for investors who aren't as systematic, who are more discretionary. If you're not buying a huge position at cost, you're just buying a smaller position. And then it sits there and it's cheap for a while, so you do get to know it a little bit better, get more comfortable with it, buy a little bit more. And if it keeps on sitting cheaply, then there's always two thoughts. Is it because I'm missing something obvious that everybody else can see, or is it the opportunity still exists, so keep on buying? There's no research behind that, folks. That's just me guessing off the top of my head.
Well, and I would say that an extended bull market would make you feel like you should, as soon as you have a good idea, put most of your chips in so that you can get
It
exposure
rewards you.
because everything's moving away from you, right? Like, so what do you need to do? Like, well, I got a great idea. I need to like load up on it, right? Back the truck up. But that's not always the case in the world. And sometimes the price comes to you even more than it did before. And what was cheap gets cheaper. And boy, it sure is nice to have like some extra capital put aside to be able to like double down when the price is halved on you, even though you thought it was cheap when you were buying it the first time, and continually lowering that cost basis through a down cycle. Like I think you can build real wealth there.
There's only two things that happen. If you load up immediately, that's not the bottom. The price is going to go down a little bit more. But if you nibble, then it runs away from you. That's all that ever happens.
Those are the only two
The market
scenarios.
does exactly what you don't want it to do.
Yeah.
The key is to buy and then let all your family and friends know about it. And then just wait for the bottom to drop.
That's it. That's it.
That's a good way to get a 70% drawdown.
Immediate drawdown.
Yeah.
I mean, what's a drawdown? How long since you've had a drawdown?
I know. Yeah, it's crazy.
I look at the valuations in the portfolios that I run, and I think that it was cheap in August 20. I mean, it's cheap in whatever the low was for that year. Was it October?
What,
Somewhere in that.
this last year?
No,
The low.
22.
Oh, 22.
22 was the last time we got cheap, I think. And since then it was just whatever late in 22. 22 was sort of down and at bottom somewhere, and then it started rallying a little bit towards the end of the year.
Yeah.
And the forward returns then were looking pretty good. I think forward returns now are looking pretty, I mean, anemic, still better than the index, but nowhere near where they were a few years ago.
To your point, Jake, it's like when stocks are going up, everybody just sees upside. And when stocks are going down, you rarely do the right thing because all you see is more problems or issues, and all you see is more downside, that it can always go cheaper.
That's why you need a valuation. You need a valuation view of the world where your whole screen is getting greener and greener and happier as the market's going down. So you're feeling better and better. And the other way around, when the market's going up, screen's filling up with red as everything's sort of getting to full value. Just train yourself to feel inverse to the market.
Well, it's also what intrigues me a little bit about, getting back to like the GOAT investors that have like a 20% CAGR. It's like a firm like Turtle Creek, out of Canada. They kind of have a deep value bent, but they're actively trading. Like every day as something gets closer to intrinsic value, they're shaving it off as it gets further away. They're adding to it on a daily basis. And they actually kind of break down like our activity in the portfolio added this much alpha during the year, where if we were just pure buy and hold, in these 30 securities, it would have been.
What do they estimate that it adds?
What's that?
What do they estimate that it adds in terms of performance?
Well, they give it by company. So I have to look at their latest presentation. I think they've done 19% net for 25 years, and I forget what the difference is, but they're another one of those, again, they kind of do things differently, where at least most investors are kind of bought into this buy and hold forever, don't touch it, quote a philosopher, or something, where like they take it different. Like, no,
Ouch.
we're gonna turn the the subject people don't like to talk about, which is selling. We're going to innovate on that and reintroduce that back and make that our advantage. And that's why kind of back to the kind of Melby example, and then them is another example that I think are kind of doing a skill differently than most. And it doesn't mean everybody should be doing that, but I think it's interesting, that ability to really be, well, first accurate in your assessment of intrinsic value first, and then acting on it almost on a daily basis once it gets too expensive or gets less expensive.
Imagine how frustrating it would be though to realize like, God, if I would have not even come into the office this year, we'd all be better off.
Yeah, the inertia analysis. It's like,
Yeah,
yeah,
the inertia
I did
analysis.
that in our letter this year, and of course, I'm only going to do it when my activity adds to the.
Yeah, drop
Yeah,
that out
smart.
on the.
Yeah, next year it will not be included in my annual letter.
Or
There's
the
a
other one, the equal weight one, is another one that can make you equal
Yeah.
weight your own
oh yeah.
portfolio.
Yeah.
What am I doing here?
Yeah.
There's an investor whose name just escapes me a little bit, but he's a large cap activist. Comes from a background in European private equity, and he's been running this thing out of New York for this 20 years, could have a 20-year track record. And he estimates that he gets 20% of his returns from trading around positions because they only hold 5 to 8 positions and they hold them for a long time because they're activist or engaged behind the scenes. So they can't trade around them all. Like they can't trade in and out, but I guess you can trade around a position if you're an activist.
Mm.
I like that. I like that as an approach, man. I think that makes sense. As something's
Mhm.
going up, the opportunity's going away, and so it should be a smaller part of your portfolio. It's the risk reward is changing
Yeah.
all the time. I don't know if it's changing daily. I'm not saying necessarily that you can do it to that level of precision, but probably across a whole book, you got to change a few positions around.
Well, I think when you're concentrated like that too, Toby, like in 8 positions, I know there's a few of them that I own that you've owned for years, and you know the management teams really well. You have a really good pulse on that company, its value, and how it's not accurately reflected in the share price, or maybe it is, and being able to take advantage of that. Like there's plenty of like there's 3 or 4 names where I feel like I'm fairly accurate in probably being able to trade them. Like, all right, this is a little bit
Yeah.
expensive. It's, oh, it's definitely a buy here, because you have that knowledge of it. It's almost like the pulse of the company.
Yeah, I try to get that. I try to get that effect trading in the stuff that I run. We'll just buy a position when it goes down, back to equal weight, sell a position if it's gone up, back to equal weight. I think you get a little bit of that. I like that Shannon's demon
Mm.
idea in a portfolio, and it helps to have a few things that are working against each other in the portfolio so that when something's working, something else isn't. You can rebalance across.
Yeah, it's kind of the farmer's fable thing too.
What's the farmer's fable?
That's where we did a segment on this, but it's basically like if you trade, uh, let's say like one farmer has a bad year and the other one
Oh
has a
yeah,
good year, and then you give some of the seeds to the other one, like you're able to kind of you actually it's limiting volatility drag at the end of the day.
Hmm.
in coming up on time, got anything you want to promote or let anybody know how to get in contact with you or follow along with
Uh,
what you're doing?
let me see if I can think of something to promote. Now, we are maybe one thing that's worthwhile mentioning. I'm the Microcap Club's teamed up with Bobby Kraft of Planet Microcap, and we're doing an event in Las Vegas, April 22nd to 24th. It's free to attend. You don't have to be a Microcap Club member or part of the community to attend. As long as you're a Microcap investor, you can come. And we're excited about that. I think it's going to be
Yeah, is
the
that
biggest.
companies coming in, or what's
Yeah,
the
we
kind of
have.
the?
So we're up to 315 investors registered, and then I think we have 60 companies, and it's a really good lineup of companies, like, profitable, growing. There's not too many story stocks in that list. So it's good. I think it's going to be the best large format microcap event in the United States. Will be this one coming up. I mean, maybe a lot of listeners don't realize this, but most microcap events in the United States, it's basically just a sea of service providers trying to sell each other something. There's very few real investors that attend. And so, to be at 315 real investors, that's probably 300 more than normal microcap events. And we have people flying in from around the world. So it's going to be an awesome experience for people if they want to come out and see the best of what microcap has to offer.
Good stuff.
Yeah, should be fun.
JT, anything to add?
No, just again, I appreciate you guys humoring me on our little skit that
No,
we
it's good
we
stuff.
did. I wish I would have had more time to polish the writing, but it occurred to me last
I don't
night,
think the
and I was
writing was
like,
the problem.
let's just go
Yeah,
for
I would have
it.
still fumbled the words, Jake, so it doesn't really matter.
I'm sure if we did a second take, it would have been golden.
Best take's your best take.
Okay.
I don't